Welcome back to SenseTalking, everyone. Thanks for being with us. We are diving deep today into, well, one of the most explosive concepts circulating in global finance right now, the open finance revolution. But we're not talking Silicon Valley or London today. Nope. We are focusing squarely on Kenya, a market already dominating digital finance and the massive, really transformative potential it holds to lead the world into the next evolution of financial services.
That's absolutely right. And our mission today, it's very specific. It's driven entirely by boots-on-the-ground analysis. We've been digging into insights from extensive, quite detailed industry consultation sources, think reports from the Kenya Bankers Association, FSD Kenya, the Association of Fintechs in Kenya.
Okay.
And we really need to understand not just what open finance is, but precisely why Kenya is so well positioned to be maybe the global test case. What challenges does it solve in the current ecosystem there? And maybe most critically, how does the industry actually want to structure and implement this, well, profound change?
Okay, let's unpack this. Starting with the basics, a lot of people hear open finance and they immediately think open banking. How are they different? What makes open finance, fundamentally distinct? And what's the mechanism actually powering it all?
Right, good question. Fundamentally, open finance, it sort of extends the principles of open banking. Open banking traditionally, that focuses mostly on, say, bank current accounts payments data. Open finance casts a much wider net. We're talking about data related to your investments, your insurance policies, maybe your pensions, and crucially, especially in the Kenyan context, data held by mobile network operators, MNOs, and SAGOCOs.
So it's a much, much broader picture of a consumer's financial life. And the mechanism you mentioned, the core of this, it's the API, right? The application programming interface.
Exactly.
You should probably frame this simply, maybe like a secure digital handshake.
Yeah.
Allows two systems to talk to each other, share data instantly.
That's a good way to think about it. But the real power here, the thing that makes it revolutionary, not just technical, it's consumer control. Absolutely. The core principle, the bedrock, is that you, the consumer, own your financial data, and you have the choice and the capability to securely share it with whoever you decide is appropriate for whatever purpose you choose.
That feels like a radical shift because right now, often your data feels locked away, siloed, right? Sharing it is clunky, maybe downloading a PDF statement or something.
Exactly. It's often discretionary, non-standardized. Open finance aims to flip that script entirely.
Okay, so when a customer gets that power, the ability to share their complete financial picture, mobile money, savings, credit, insurance, everything there, what are the real tangible benefits? What's the big aha moment for, say, the average Kenyan user?
Well, the primary benefit, I think, without question, is enhanced personalization and efficiency. Just imagine you walk into a bank or maybe use a digital lending app, and instantly, with your consent, they can access your full cash flow history from M-Pesa, maybe your Saxo deposits, your existing loan situation.
Oh, okay.
This means they can give genuinely tailored advice, product recommendations. It leads to massively improved risk rating, and ultimately, better financial decision-making for you, the consumer.
And that efficiency, it's not just for the consumer, right? It must fuel innovation too. If smaller fintechs don't have to rely on the, let's say, willingness or maybe the slowness of the big players to share data, that breaks down those old walls, those data silos.
Precisely. It fosters a genuinely competitive marketplace. New firms can potentially enter, look at comprehensive customer data again, always with consent, and develop products that are, frankly, impossible to offer right now.
Right.
And this competition, naturally, it drives up service quality. And ideally, it should push down pricing for things like credit or insurance. What's fascinating here is Kenya's really remarkable digital finance journey makes this particularly relevant. They aren't starting from scratch here.
No, not at all.
They have this massive foundation that, many other emerging markets just don't have yet.
They absolutely do. The sources, they paint this picture of incredible digital potential. We're talking, 84.8% of Kenyan adults with access to formal financial accounts? That number alone is phenomenal.
It really is.
But maybe more telling is the mobile money adoption rate. 52.6% use it daily. That signals a highly engaged, digitally native population, huge transaction volumes.
So you've got this tech-savvy user base, a diverse ecosystem, established banks, powerful MNOs, nimble fintechs. It sounds, on the surface, like the perfect breeding ground for open finance. Yet the consultations revealed the significant, almost paradoxical constraint. fragmentation.
Ah, okay. That's the critical pivot point then. Despite all that digital success, the way data is shared now is limited, it's siloed, it's kind of messy. If I'm reading the source material right, the big problem is this reliance on bilateral agreements, those one-to-one deals between firms.
That seems to be the systemic failure point, yes. These bilateral arrangements, they're incredibly complex, they're expensive to set up and maintain. Think about it. Every time a bank wants to integrate with a new fintech or an MNO, they have to negotiate individual contracts, manage different tech requirements, deal with often substantial legal fees.
Right. It sounds exhausting.
And this lack of standardization, it just means the whole system is bogged down by inefficiencies. It slows the pace of innovation right down.
That's a great point on the cost and complexity. If there's no common rule book, no shared standard, you're constantly reinventing the wheel for every single connection. So what are the specific, painful details, the kind of gotchas that open finance is really designed to fix?
Okay, we can start with data formats. This came up a lot. Different financial service providers, FSPs, they use radically different formats for customer statements, transaction records. This makes standardized interpretation incredibly difficult. The sources, they highlighted the struggle of, say, MSMEs, small businesses, trying to track and reconcile cash flow when they're getting statements from 5 different providers in 5 different formats.
I remember reading that anecdote about schools, too. That really brought it home. Schools dealing with thousands of digital fee payments, struggling to reconcile the money coming in because the payment providers send the data in wildly inconsistent ways.
Exactly. It requires manual workarounds, which totally defeats the purpose of digital speed and efficiency.
Okay, so inconsistent formats is one pain point. What else?
Another major one is the quality of Know Your Customer data, KYC data. Even those mobile money registrations, which are so central to Kenya's ecosystem, sometimes the data is outdated or inaccurate.
Right, people move, change numbers.
Precisely. Phone numbers, addresses, formal IDs change. And if the data is static, meaning it isn't regularly updated or verified, it can cause failures in digital verification processes. A standardized open finance identity layer could, theoretically, continuously verify and clean up these databases. That's essential if you want to rely on digital ID verification.
Okay, that makes sense.
Yeah.
And the third one you mentioned, regulatory ambiguity.
Yes, that's a big one too. If I'm a bank and I'm looking at the Data Protection Act, the DPA, and I see uncertainty about who's liable if I share customer data through one of these bilateral deals, well, my default response is probably going to be caution, risk aversion.
Makes sense. You'd hesitate.
That hesitation is perfectly rational. Regulatory ambiguity around liability, how specific consent needs to be, how data can be used, it just adds layers of complexity and cost to integration. Without a clear national standard, firms tend to default to the safest option, which usually means slowing down data sharing, either for competitive reasons or liability concerns.
Okay, here's where it gets really interesting. How open finance actually aims to cut through all this fragmentation. It does that by prioritizing specific types of data, right? Moving away from this patchwork towards a national standard.
That's the strategy. To really catalyze the system, the industry stakeholders, through these consultations, seem to coalesce around 4 core data types for an initial phase. First, identity and KYC data. Foundational. It's about building a common, reliable identity layer, improve registration, improve identity confirmation across all platforms.
Okay, number 1, identity. What's second?
Second, payments and mobile money accounts. Given how central mobile money is in Kenya, this is just non-negotiable. We're talking about sharing that rich, real-time cash flow data you get from these accounts.
And this is where it really changes things for, say, credit assessments.
Oh, absolutely. It's a huge shift. We're moving beyond just looking at, traditional bank statements from last month. The sources specifically mention needing access to real-time transaction data, things like current balances from short-term digital credit products like Fuliza. Ah, interesting.
That level of granular moment-to-moment data gives a much sharper, much more dynamic view of a consumer's actual ability to repay compared to relying on, say, old static CRB data.
It's like the difference between looking at an old photograph of someone's finances versus watching a live video feed of it.
That's a perfect analogy. Okay, so third data type, deposit accounts. Starting with commercial banks, but with a plan to phase in other non-bank institutions, like deposit-taking microfinance institutions, DTMIs, and, importantly, SEIOs.
Got it. And the fourth?
And finally, credit data itself. This means standardizing how existing Credit Reference Bureau, or CRB, data connects with new data from all lenders, ensuring that every financial interaction contributes to building a more accurate, holistic risk profile. This move from static to real-time transactional data, that's really the key to unlocking the biggest benefits. And this focus, it seems very strategic. It looks designed to tackle some of the biggest structural challenges in the Kenyan economy, specifically helping MSMEs in the agriculture sector.
Yeah.
Why a focus on MSMEs? Why should we care about that specifically in this context?
Well, because the scale of the problem is just enormous. Kenya faces an estimated MSME finance gap of, get this, around $19.3 billion.
Wow.
Most of these businesses operate informally or maybe semi-formally. They often don't have the clean, standardized financial statements that banks traditionally require. So they're often deemed too risky simply because there's no easy way to verify their actual financial health.
So open finance potentially changes that whole risk calculation
Yeah.
by enabling this standardized consented sharing of real-time cash flow transaction history. Suddenly, a lender can build a much more accurate risk profile for, say, an informal vendor or a small farmer.
Exactly. And this allows for several really specific, powerful innovations. You could see the rapid creation of tailored business loans, specifically for informal enterprises based on their actual daily or weekly revenues, tracked via mobile money. It could facilitate specialized MSME business management tools, apps that help owners track inventory, manage cash flow, things like that. And crucially, it could lead to reduced interest charges, because if the risk models are better, there's less uncertainty for the lender, meaning potentially lower capital provisioning needed.
That makes a huge difference. Okay, moving from the what to the how. Implementing such a massive data-sensitive system obviously comes with huge responsibility. The sources seem unanimous on the single biggest implementation risk: data security and privacy.
Oh, absolutely. This concern just dominated every stakeholder consultation we looked at. We're talking about the risks of large-scale data breaches, unauthorized data usage by third parties, and just the sheer complexity of managing explicit, easily revocable consent when one consumer's data might be accessed by, potentially dozens of different accredited players.
Yeah, that's...
As one survey respondent put it, quite starkly, weaknesses in any provider system could expose consumer data, undermining trust across the entire ecosystem. The whole thing is only as strong as its weakest link.
That is genuinely terrifying. It means the policy framework, the rules, they had to be absolutely ironclad from day one.
Oh.
What did the sources suggest are the essential safeguards needed?
Well, the implementation must mandate clear technical and operational standards. That's table stakes. There needs to be a robust, probably centralized, accreditation and vetting process for everyone participating, including any third-party aggregators who might handle the technical data routing.
Okay.
And crucially, this all has to ensure absolute alignment with Kenya's Data Protection Act, the DPA. They'll also need to develop specific, very user-friendly rules for consent: how it's granted, how it's tracked, and perhaps most importantly, how easily it can be revoked by the consumer at any time.
Right, putting the user back in control. Okay, another unavoidable hurdle seems to be market dynamics, specifically market concentration. If, hypothetically, one entity holds, say, 91% market share in the mobile money space, relying purely on voluntary efforts to share data might not work, right? Because that dominant player might have a competitive incentive not to play ball with standardized integration.
That is the absolute central tension in the implementation debate. If the potential benefits are huge, but the largest players aren't compelled to participate, then the system probably fails to achieve critical mass. It doesn't deliver for everyone. And the consensus in the consultations reflected this exact concern. About 65% of respondents favored some form of a partially mandated approach to compel participation from key players.
So some level of government intervention or regulatory push is seen as necessary to ensure fairness and make sure the benefits reach everyone. A purely voluntary approach might just let the big market leaders maintain their data moats.
Precisely. And this leads directly into the discussion around the favored governance model. The preference seems to be for a mixed governance approach. What that means is the leadership should be government-led, likely the Central Bank of Kenya, the CBK setting the policy mandates, the legal framework, the technical standards.
Okay, top-down direction.
Yes, but the actual implementation, the execution, should happen through a shared governing body or maybe a council. This council needs formal representation from the industry itself, banks, MNOs, fintechs alongside policymakers, to leverage their technical expertise and ensure the rules are actually workable on the ground.
That sounds like a delicate balancing act. Regulatory oversight plus industry agility. But where there's technology, complexity, new infrastructure, there's usually cost. And the most contentious point raised, the one where there was seemingly no agreement, was the pricing controversy. How should accessing this data actually be monetized, if at all?
Yeah, that was utterly conflicted. Reading through the responses, industry opinion basically broke down into three distinct mutually exclusive camps. Camp 1 argued for no charging allowed at all. They believed the mutual benefits innovation, efficiency gains should essentially offset any operational costs of sharing data.
Okay, free access.
Camp 2 argued for a fixed, regulated subscription price, something maybe similar to utility pricing, predictable and standardized. And Camp 3 pushed for liberal commercial rates. Basically, let the firms who invested in collecting and holding the data charge whatever the market will bear for access.
Wow, that's a huge gulf in opinion. No charging, fixed price, or open market rates. That seems like a perfect indicator of where policymakers just have to step in. Because the incumbents holding the data naturally want to monetize their asset, while the innovators and challenger firms need low-cost access to build new things.
Exactly. This lack of consensus pretty much proves that the policymaker, likely the CBK, will have to intervene and set some initial rules. Rules for cost recovery, rules for pricing. They need to be seen as fair and probably need to be adjustable over time as the market evolves, because relying on the industry to voluntarily agree on this, it just doesn't seem likely to resolve this fundamental commercial disagreement.
Great.
If we connect this to the bigger picture, open finance in Kenya, it isn't just about adopting some new tech standard. It's really about building trust. It's about effective, collaborative governance between the regulators and what is a highly concentrated, yet also highly innovative, financial industry. Success really hinges on that policy framework, providing clarity and certainty where right now there's ambiguity and, frankly, significant commercial tension.
Absolutely. So the core takeaway for you, the listener, is that open finance really does look poised to be Kenya's next once-a-generation innovation in financial services. It's driven by putting you in control of your data and by standardization across the board. But, and it's a big but, this transformation is only likely to succeed if the policy implementation tackles those critical risks, data security first and foremost, and ensures fair, broad market participation from everyone.
And maybe here's a final thought to leave you with. This fundamental shift towards using real-time transactional data like your daily cash flow from mobile money accounts for things like lending. It means that your spending habits, your lifestyle choices, reflected in your digital footprint, maybe even more than your formal assets on paper, are rapidly becoming your most valuable financial asset. Open finance promises to put the control over that incredibly valuable asset firmly back in your hands. The question is, how will you choose to leverage that control in this emerging financial ecosystem?
This deep dive was supported heavily by FSD Kenya's extensive research and studies. Thanks.